In an era where cryptocurrency continues to capture the imagination of both retail and institutional investors, navigating the complex landscape of digital assets can be daunting. J'JO35, a Singapore-based startup, is stepping up to simplify this process with its innovative J'JO35 crypto index. Launched on March 9, 2025, this automated indexing solution aims to make diversified crypto investing more accessible and less risky for everyday investors. The J'JO35 index comprises the top 35 cryptocurrencies by market capitalization, providing a structured approach to investing in a market that many find overwhelmingly speculative. According to J'JO, approximately 90% of retail crypto investors incur losses, often due to poor timing, speculative trading, and a lack of effective risk management strategies. The company's co-founder Andrei Ponomarev highlighted this issue, noting too often new users end up losing in this market and never returning. But our index solutions address this by making portfolio diversification easier than ever before. With J'JO35, investors can onboard seamlessly with just a few clicks, connecting their existing accounts from one of 11 supported exchanges, including major platforms like Binance and Kraken. Notably, J'JO does not take custody of user funds, ensuring that investors retain control while the platform automatically rebalances their portfolios every month. This hands-off approach is intended to alleviate the burdens of active management and allow users to focus on long-term growth rather than daily market fluctuations. To cater to varying levels of investment acumen, J'JO has also introduced market segment indexes, enabling more experienced investors to customize their portfolios according to specific strategies. While J'JO's Lite plan allows users to invest up to $500 for free, the Pro plan offers unlimited investing amounts and access to advanced analytics for a modest annual fee. This tiered structure is designed to empower users with the tools they need to invest confidently. The launch of J'JO's services comes at a time of significant growth in the cryptocurrency market, which witnessed a staggering 27,000% increase from January 2014 to December 2024. However, the market's volatility remains a double-edged sword. As Ponomarev pointed out, the growing interest from institutional investors has created a demographic of non-crypto natives eager to participate, further emphasizing the need for user-friendly solutions that mitigate risk. As J'JO positions itself as a reliable entry point into the crypto space, it reflects a broader trend toward automation and simplification in financial services. By lowering the barriers to entry and providing tools that promote diversification, J'JO aims to reshape how retail investors interact with cryptocurrencies, making it possible for them to invest in a structured, informed manner. Looking ahead, the success of J'JO's indexing approach could influence the development of similar platforms, potentially paving the way for a more stable and diversified crypto investment landscape. As the industry continues to evolve, the demand for accessible, risk-conscious investment solutions will likely grow, marking a significant shift in how digital assets are perceived and utilized by the general public. In the ever-evolving landscape of cryptocurrency, two names frequently dominate discussions: Tether and Bitcoin. While both have carved out significant niches within the digital financial ecosystem, recent analyses reveal a persistent issue that could hinder their long-term viability as alternatives to traditional fiat currencies, particularly the US dollar. As the cryptocurrency market grapples with volatility and macroeconomic pressures, the question arises: can Tether and Bitcoin truly replace the dollar, or are they merely extensions of its inherent instability? Tether, a stablecoin that has become integral to the cryptocurrency trading ecosystem, facilitates a staggering 4 out of 5 crypto transactions today. This figure underscores its importance, yet it also highlights a fundamental issue: Tether's peg to the dollar is what grants it its perceived stability. As John Tamny points out in a recent Forbes article, while Tether provides a digital alternative in a world fraught with unreliable currencies, it does not escape the dollar's volatility. In fact, Tether's stability mirrors that of the dollar, making it an extension rather than a replacement. The dollar itself, despite its global dominance, has shown signs of instability over the past 25 years. When compared to currencies like the euro, pound, and yen, The dollar's volatility may not be as pronounced, but it remains susceptible to inflationary pressures. Tamny asserts that inflation is often mischaracterized. It is not merely about rising prices but rather the diminishing value of the currency itself. In this light, Tether's ability to function as a stable medium of exchange is contingent on the same factors that impact the dollar. Bitcoin, on the other hand, is often heralded as the digital gold of cryptocurrencies, with proponents touting its limited supply as a hedge against inflation. However, Tamny argues that Bitcoin's speculative nature and historical volatility render it ill-suited to function as a stable currency. While it may attract investors seeking scarcity, its price fluctuations undermine its utility as a reliable medium of exchange. The growing consensus among analysts is that Bitcoin, while valuable as an asset class, lacks the qualities necessary to replace the dollar. Recent market movements further illustrate the challenges facing Bitcoin amidst broader economic concerns. As macroeconomic factors such as escalating trade tensions and Federal Reserve policies come into play, Bitcoin has struggled to maintain its value. Over the past few days, the leading cryptocurrency saw a significant decline, testing critical support levels amid fears tied to ongoing tariff wars and uncertain monetary policy. The situation was exacerbated by a lack of confidence in the current administration's approach to economic management, leading to a cautious investor sentiment that has heavily influenced market dynamics. As the cryptocurrency market continues to mature, the discourse around Tether and Bitcoin's roles as potential replacements for the dollar remains contentious. While both have carved out essential roles in the digital economy, their ties to the dollar's instability raise critical questions about their long-term sustainability. Analysts predict that until a truly stable digital currency emerges, one that is not tethered to the fluctuations of fiat currencies, the dollar will maintain its preeminent position in global finance. Looking ahead, the cryptocurrency community must navigate these challenges carefully. The potential for innovation and the development of more resilient digital assets exists, but whether Tether and Bitcoin can evolve beyond their current limitations remains uncertain. As traditional financial systems adapt to the rise of cryptocurrency, the path forward will depend on how well these digital currencies can establish themselves as trustworthy alternatives to the dollar rather than mere reflections of its flaws. In a surprising turn of events, President Donald Trump has unveiled his administration's ambitious plans to establish a strategic reserve for cryptocurrencies, including Bitcoin, Ethereum, Ripples, XRP, Solana, and Cardano. This announcement, made during the highly publicized White House Crypto Summit, has sent ripples through the cryptocurrency market, which has seen a mix of excitement, skepticism, and volatility in the wake of the news. As Bitcoin prices hovered around $85,000, they showed a stark contrast to the fluctuations experienced shortly after Trump's announcement of the crypto reserve. The market, which had previously enjoyed a significant rally, has recently flatlined, with the price of Bitcoin seeing a decline from its early March peak. Analysts noted that the lack of new purchases and a focus on consolidating existing government holdings have left traders feeling uncertain. David Sachs, appointed as the administration's crypto czar, stated the purpose of the stockpile is responsible stewardship, under the direction of the Secretary of the Treasury, who will figure out how to maximize the value of these holdings. Trump's plan to position the U.S. as the world's Bitcoin superpower comes after a period of regulatory uncertainty that has plagued the crypto industry under previous administrations. The idea of a U.S. crypto reserve is not merely a symbolic gesture, it aims to legitimize cryptocurrencies as an asset class. During the summit, Trump emphasized, "We're taking historic action to deliver on that promise," reflecting a commitment to elevating Bitcoin and other digital currencies to a status comparable to traditional assets. However, the announcement has drawn mixed reactions. Critics argue that the government's foray into the cryptocurrency space raises ethical concerns and questions about the necessity of holding volatile digital assets. Economist Jason Furman expressed skepticism, stating there is no argument for why the government should be buying it and holding it, highlighting the risks associated with market volatility. Meanwhile, Peter Schiff, a prominent critic of Bitcoin, dismissed the entire notion as a gamble rather than a viable investment strategy. Despite the criticisms, there are indications that Trump's strategy could potentially catalyze broader global adoption of cryptocurrencies. Analysts have suggested that the establishment of a U.S. crypto reserve might prompt other nations, including China, to consider similar moves, thereby accelerating the shift of digital assets into national reserves. The U.S. Bitcoin reserve raises the likelihood of other nations adopting similar reserves, noted analysts from Tegas Capital, pointing to a possible trend where digital assets could begin to rival traditional assets like gold. In the midst of these developments, macroeconomic factors are also influencing market sentiment. Ongoing trade tensions between the U.S. and China, coupled with the Federal Reserve's cautious stance on interest rates, have overshadowed Trump's crypto announcements. Bitcoin's recent decline, from highs above $92,800 to testing key support levels, highlights the market's sensitivity to broader economic indicators. Crypto analytics firm Into the Block noted, despite the very positive news, Bitcoin fell 4% as tariff war fears accelerate, underlining the complex interplay between macroeconomic conditions and crypto prices. As the Trump administration moves forward with its strategic reserve plans, the focus will likely shift towards how these initiatives are implemented and the potential for future crypto acquisitions. Although the executive order prohibits using taxpayer money for purchasing additional cryptocurrencies, it leaves open the possibility for acquiring Bitcoin through budget-neutral methods such as selling other government assets. In conclusion, Trump's ambitious crypto strategy represents a significant shift in the U.S. government's approach to digital currencies. While it could pave the way for increased legitimacy and acceptance of cryptocurrencies, it also raises critical questions about the management of such volatile assets and the broader implications for the economy. As the landscape evolves, stakeholders will be keenly observing how these developments unfold in the coming months, particularly in light of ongoing macroeconomic challenges and the global response to the U.S. initiative. In a bold move that has captured the attention of the cryptocurrency world, former President Donald Trump has unveiled plans that could redefine the role of digital assets in the United States. According to a recent announcement, the U.S. Treasury will work on strategies to maximize the value of Bitcoin and other cryptocurrencies, including Ethereum, Ripple's XRP, Solana, and Cardano, held in government reserves. This announcement, made during a White House summit, has sent ripples through the crypto markets. As investors grapple with the implications of the U.S. aiming to become a dominant force in the digital currency arena. As Bitcoin prices hovered around $85,000, mirroring levels from earlier in March, market observers noted a troubling stagnation across major cryptocurrencies. The excitement surrounding Trump's vision of establishing a digital Fort Knox for Bitcoin has not materialized into immediate price gains. Instead, it has prompted skepticism, particularly in light of Elon Musk's recent price warning and ongoing concerns about crypto regulations. David Sachs, an investor and the newly appointed crypto czar in Trump's administration, emphasized the significance of the proposed digital stockpile. The purpose of the stockpile is responsible stewardship, under the direction of the Secretary of the Treasury, he stated during the All In podcast. The intent is to adopt sound portfolio management practices, leveraging the expertise of Treasury Secretary Scott Bessent, a former hedge fund manager, to oversee this ambitious initiative. Despite the excitement, investors have expressed concern over the lack of commitment to new Bitcoin purchases, viewing the executive order as an effort to consolidate existing assets rather than expand them. Sachs acknowledged that the government had previously sold off a substantial portion of its Bitcoin holdings, about 400,000 BTC, with half sold for a mere $360 million. If we had held all of that, just that the portion we sold would be worth over $17 billion, he lamented, highlighting a significant missed opportunity. Market reactions to these developments have been mixed. Amy Ling, head of growth at WeFi, noted that the government's lack of new purchases has triggered uncertainty in the crypto market. However, she also pointed out that the mandate to acquire Bitcoin through budget-neutral methods could lead to innovative funding solutions. such as Bitcoin bonds or reallocating resources from existing gold reserves. The U.S. move to formalize a Bitcoin reserve may prompt other nations to follow suit. Analysts at Tegas Capital suggest that this could accelerate global adoption of Bitcoin, with countries potentially shifting their reserves from gold to digital assets. The U.S. Bitcoin reserve raises the likelihood of other nations adopting similar reserves, they noted, highlighting the potential for a competitive landscape among sovereign states in the digital currency arena. While Bitcoin remains a focal point, other cryptocurrencies are also experiencing turbulence. Ethereum, for example, has faced significant outflows from exchange-traded funds ETFs totaling $455 million recently. Its price has stagnated around $2,100, markedly lower than historical highs. The competition from other blockchain networks such as Solana and BNB, and the limitations of Ethereum's ETF structures, particularly the inability to stake, have contributed to this downturn. Despite the challenges, there are signs of resilience. Ethereum has experienced a surge in accumulation, with substantial withdrawal activity from exchanges indicating bullish sentiment among traders. Should Ethereum maintain its current support levels, analysts predict it could rally toward $3,260, though risks of a reversal remain if downward pressure increases. As the landscape of cryptocurrency continues to evolve, Trump's strategic plans signal a turning point that could usher in a new era for digital assets. The U.S. government's actions in the coming months will be crucial in determining whether the country can truly position itself as a leader in the cryptocurrency domain. With a potential race among nations to adopt digital reserves, the economic implications could be profound, reshaping not only the crypto market but also the traditional financial landscape. As investors watch closely, the next steps taken by the U.S. Treasury will likely set the stage for a transformative shift in the global economy. In a striking turn for the cryptocurrency market, Solana has experienced a significant decline of nearly 29% since the beginning of 2025, despite being included in President Donald Trump's newly announced digital asset stockpile. This initiative aims to bolster the U.S. crypto landscape, yet Solana's recent performance raises questions about the broader implications of such endorsements. The situation underscores a complex interplay of market dynamics, investor sentiment, and emerging trends within the crypto space. TradingView data reveals that Solana, which recently stood at $126.18, has not only failed to capitalize on the $10 billion surge in new liquidity but has also seen its price drop dramatically. This decline is particularly alarming given that Solana is one of only 3 altcoins, alongside Cardano and XRP, featured in the digital asset stockpile. Even with this high-profile endorsement, Solana has struggled to break free from its downward trajectory. The influx of over $9.5 billion worth of newly minted USDC stablecoins since the start of the year has not translated into a recovery for Solana. Analysts suggest that much of this liquidity has instead flowed into memecoins, highlighting a shift in investor preference. As Dan Hughes, founder of the decentralized finance platform Radix, noted, most of the inbound liquidity was outflow from other crypto assets. People selling their crypto portfolio to buy Trump and extreme FOMO. This behavior reflects a broader trend where speculative trading drives capital away from established projects like Solana. Adding to the concerns, Solana has faced significant outflows, with over $485 million leaving the platform in February alone. Investors appear to be seeking safer havens, gravitating towards assets like Ethereum and the BNB chain amid growing fears of memecoin scams. A Binance research report pointed out that Bitcoin's dominance has risen to 59.6%, indicating a market-wide flight to perceived stability. The fallout from recent memecoin launches has further dampened investor enthusiasm for Solana. Notably, the controversial launch of the Libra token, which collapsed dramatically after insiders allegedly siphoned off over $107 million, has left a sour taste among investors wary of potential scams. This incident has contributed to Solana's struggle, as trust erodes in a market characterized by volatility and uncertainty. Despite these challenges, analysts are keeping a close watch on Solana's price patterns for signs of potential recovery. Currently, Solana is forming a broadening wedge on its price chart, which historically indicates an increase in volatility and the possibility of a breakout. Traders are particularly focused on key resistance levels, with $150 to $160 being crucial for any bullish reversal. The Relative Strength Index RSI sits at 42.71, suggesting that there is still room for upward movement before reaching overbought territory. As the cryptocurrency market continues to evolve, the immediate future for Solana appears precarious but not devoid of potential. The upcoming days will be critical in determining whether it can regain momentum or if it will remain trapped in a consolidation phase. Investors and analysts alike will be monitoring key price levels closely, as breaking through resistance could pave the way for a significant rally. In conclusion, while Solana has faced a difficult start to 2025, its future remains uncertain. The combination of high-profile endorsements and significant liquidity influx has not yet translated into positive price action, reflecting broader market trends and investor sentiment. As the crypto landscape shifts, all eyes will be on Solana to see if it can navigate these challenges and reclaim its position in the market.